Money used to move through banks. Now it moves through code. How is digital money changing the global financial system? For decades, money has been controlled by banks, governments, and financial institutions. Transactions were slow, intermediaries were necessary, and access depended on geography and regulation. Digital money is changing that structure. Not by replacing the system overnight, but by reshaping how money is stored, transferred, and controlled. 10 ways digital money is transforming the financial system. 1. Faster and borderless transactions. Digital systems allow money to move across countries in seconds instead of days. This reduces reliance on traditional banking networks and makes global transactions more efficient. 2. Reduce dependence on intermediaries. Traditional finance requires banks, payment processors, and clearing systems. Digital money, especially blockchain-based systems, can reduce the need for these intermediaries, lowering costs and complexity. 3. Greater financial inclusion. People without access to traditional banking can participate in digital financial systems using smartphones. This expands economic participation in developing regions. 4. Rise of central bank digital currencies, CBDCs. Governments are exploring digital versions of national currencies. These allow central banks to have more direct control over money distribution, payments, and monetary policy. 5. Increased transparency and traceability. Digital transactions can be tracked more easily than cash. This can reduce fraud and improve accountability, but it also raises concerns about privacy and surveillance. 6. New forms of private money. Cryptocurrencies and stablecoins represent alternative forms of money outside traditional banking systems. These challenge existing financial structures and introduce new competition. 7. Programmable money. Digital money can be programmed with conditions, such as automatic payments, restrictions, or triggers. This changes how contracts, salaries, and financial agreements work. A. Pressure on traditional banks. As digital systems grow, banks may lose their central role in payments and money transfer. They may need to adapt by offering new services or integrating digital technologies. 9. Faster policy transmission. With digital systems, governments and central banks can distribute funds directly to individuals and businesses, improving the speed and effectiveness of economic stimulus. 10. New risks and instability. Digital money introduces cybersecurity risks, regulatory challenges, and potential volatility. Without proper control, it can create new forms of financial instability. Final truth. Digital money is not just a technological upgrade. It is a structural shift in who controls money, how it moves, and how quickly power can change. The system is not being replaced overnight, but it is being rewritten.